Good morning and welcome to the Forward Partners Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab, which is situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. And I'd now like to hand you over to Nick Brisbane, CEO. Good morning to you, sir.
Good morning, everybody. Welcome to the Forward Partners 2022 results presentation. Thank you for taking the time to listen in. So as you'll remember, we are a venture capital company, and the story that we're going to tell you today is that there's real strength in our underlying portfolio, really good performance there, but that was coupled, unfortunately, with a disappointing year from a valuation perspective, and that was due to valuation headwinds emanating from the public markets. So underlying portfolio company performance is, of course, what's most important, and it's that strong performance coupled with the ever-present strong tailwinds in the tech ecosystem that are making us once again increasingly excited about the prospects for Forward Partners. So what we're going to do today for the next 20-25 minutes, we'll run you through our results presentation, and then we'll get to the questions which you leave in the Q&A at the end. Okay. So we'll kick off with some quick intros. I'm Nick Brisbane, founder and CEO of Forward Partners. I've been in venture capital for over 20 years now, and prior to founding Forward, I was a founding partner at Malton Ventures, another notable listed VC. And so I founded Forward Partners 10 years ago now with the strategy of having a sector focus to make great investment decisions and to being high value add to win deals and drive better returns. And as we'll see in a minute, those are still the mainstays of the Forward strategy today. Lloyd?
Hi, you'll see the meeting now kick in. My name is Lloyd Smith. I'm the CFO for Forward Partners. I trained in EY in audit. I later moved to a PwC deals team, which was a great experience. And prior to my role joining Forward, I was the CFO of a number of companies for ATI Global. It's a group of legal technology companies, and that the revenue we grew from 1 million to 100 million there, which was very good. But I was really excited to join Forward in March 2022 because of the prospect of growing the latest and greatest new startups. And since joining, we've managed to strengthen the finance team and take the annual report to release 2 months earlier than last year. So very pleased about that.
Hi, I'm Luke Smith. I lead the ventures team at Forward. I was previously at REV Venture Partners, where our portfolio included Palantir, Babel, and Recorded Future. I started my career at Oliver Wyman doing strategy consultancy. I have a PhD in biochemistry from the University of Cambridge.
Thanks, both. So what we're going to do today is we'll begin with a reminder of who Forward is and a summary of our 2022 results. And then we will drop into market context, a bit on our portfolio construction, our financial results, of course, and then dive into some individual portfolio companies before finishing with an outlook for the year ahead. So the reminder, so Forward is an early stage VC fund. So we invest at pre-seed and seed stage. That means initial investments of 200k up to 2 million. We then follow on much more into our best companies. So think these are very young businesses, maybe 2 people to 15 people on average, that sort of range. Some are pre-revenue, some have nascent revenues. All are in really exciting markets and have big potential outcomes. So there are 2 things which really make us different from other venture firms. Firstly is our sector focus. So the reason we have a sector focus is that it allows us to build expertise and make better investment decisions. So our focus areas are marketplaces, Web3, and applied AI. And applied AI has been especially exciting recently. We've been investing in the sector for 6 years now, but with the release of ChatGPT last November and all of the excitement about large language models and generative AI ever since, it's just a great area for us right now. We're lucky actually, we've just been in the right place at the right time, having been investing in the sector for so long. So the second thing which makes us different is the studio team. So we believe that venture capital is a services business, that capital is a commodity, that the best founders have a choice. And so we work really hard to deliver the best service we can to the entrepreneurs that we back. And the most important part of that is our studio team. And you can think of that as a not-for-profit agency, which we run on behalf of our portfolio companies. So these are the highlights from 2022. I'll hand over to Lloyd and Luke to take you through the detail, but the key message from this slide, in fact, if there's one message to take from this whole presentation, it would be this one, is that we were disappointed with our valuation performance last year, but the performance of our underlying portfolio is very good. And it's that, more than anything, which makes us think it's inevitable that our valuations will start trending up again.
So as you can see, the resulting balance sheet NAV for 2022 was 96.7 million. That translated to 72 pence per share. So if you're looking at the share price today, it's roughly a 50% discount. And that's supported by cash on the balance sheet at the year end of 17.2 million, which helps us meet our OPEX and our investment requirements for 2023. And the resulting portfolio value was 18 million. That is a 39% decline year on year. However, what I draw your attention to is the fact that the portfolio declined 24% at the interims, and then it slowed to 15% for the year end. So what we do expect is that trend is now slowing, or maybe it will stop, but at this point we can't call it. But what I would draw your attention to is the fact that that is really predominantly due to valuation headwinds that have impacted the valuations in the current market that we are in. And the underlying portfolio does remain strong, and to that end, I'll pass you over to Luke.
As Nick said, we're pleased with the performance of the portfolio. So the top 15 grew revenue by 144% on average last year. And in the long term, revenue growth is the key driver for valuation growth. So we think that's a really important and exciting stat. We also think the portfolio plays into key trends with the accelerating adoption of AI. With ChatGPT and the underlying large language models, these are revolutionary technologies. They have the potential to significantly increase productivity across a whole host of industries. And they also have the potential to reduce the cost of starting and growing businesses. And our portfolio companies are tech savvy and quick moving. And so they're really well placed to take advantage of these trends. We also had a strong year from deal flow perspective. So we saw 4,000 opportunities, or more than 4,000 opportunities. We made 3 new deals. There was also a strong focus on follow-on. We responded quickly to the tough times, and we worked with our portfolio companies to help them respond. And that meant adjusting strategy, reducing burn, extending runway, and also strengthening balance sheets. And so our portfolio did well with raising external capital. And across the portfolio, we saw 55 million of investment raised last year, which is why when we look at the top 15, 82% of those by value have at least 18 months runway, or profitable, or on track to profitability. So we're pleased with the balance sheet position of the portfolio at the moment.
Thanks, Luke. And finally, for this slide, turning to the studio. So the studio has been having a very good time recently. Getting great people into our companies is one of the best ways to drive success for our portfolio. And so we refocused the studio on talent last year. And as you can see, the CEOs of our portfolio companies, they rate the service they get from our studio very highly. And that's because we make a big difference to their chances of success. So 2 areas within talent that I'd call out. So first is senior hires, high impact hires. So we recently found, for example, 2 examples, a CFO for Outthink, one of our fastest growth companies last year. And with luck, we are close to closing a new chairperson for Sonrai, one of our new investments. And so the other area where we had a great impact is helping portfolio companies make a fast start to their hiring plans after we invest. So that really helps them kickstart their growth and maximizes the chances of their next round coming sooner and at a higher valuation. So a real win there. Turning to market context. So the chart on the left shows the strong growth in venture capital in the UK over the last decade. And it's really quite remarkable when you look at that growth. I enjoy looking at that chart. So last year, investment in the UK dipped, but the long-term trend is still very much growth, and that's driven by the ever-increasing pace of change. And it's that ever-increasing pace of change that drives innovation from large companies to small companies, and much of that innovation then is in VC-funded startups. And so that trend of innovation moving from large companies to small companies, that's a trend with real legs. The pace of innovation just keeps on increasing. I'm sure you can feel it all around you. And generative AI is, of course, just the latest example of that. Now, moving to the right. So London, it's the place in Europe and maybe even the world these days to do venture capital. Ecosystem size really matters. And we're third in the world now and significantly bigger than Berlin or Paris. It's also worth noting that London and the UK are hotbeds for artificial intelligence. That was one of the reasons that we started investing in this sector back in 2017, and it remains as true now as it was then. Many kind of data points for this, but one recent bit of news is that Google just a couple of weeks ago decided to consolidate the global artificial intelligence efforts under the DeepMind team here in London. So that's the big picture market context, long-term growth with London at the centre. But turning to the last year, as we've said, it wasn't the easiest time. So what happened was that VC confidence evaporated in the face of rising inflation, rising interest rates, supply chain problems. So rather than raise money under difficult circumstances, what portfolio companies chose to do was stretch out their runways and raise small amounts so that they could maximise their valuations and their bigger raises when things recovered. Our portfolio did that, as Luke was describing earlier, and most of the rest of the market did too. That's what we have here in the chart on the left. So as a result of that, investments, and general economic malaise, investments rates fell precipitously, but they will come back. And it's not only because there's a lot of good opportunities to invest, but also because investors have raised a lot of money. So what you can see in the chart on the right is that in 2021 and 2022, they were record years for fundraising by UK venture capital funds, and that money needs to get deployed. So most of it sits in funds with windows of 3 or 4 years for new investments, and it's managed by partners who are itching to get back to building their track records. So what are they waiting for? In fact, what are we all in the VC industry waiting for? Well, we're waiting for investor confidence to return. And specifically, it's the confidence that if you make an investment in a company and it performs, then in 12 to 18 months' time, the next round investor is going to be there and ready to invest in your company at a double or more the valuation that you just invested at. And that confidence hasn't really been there for the last year. But the pent-up demand to be making deals, that's reason to believe that when that confidence comes back, that when the switch flips and confidence returns, that investment will bounce back hard. So I'll hand you over to Luke to talk a little bit about deal flow.
So as I said earlier, deal flow was strong last year. We made 3 exciting new investments, and we'll look forward to talk about those later. There's also a significant investment in follow-ons, which put the portfolio in a strong position from the balance sheet today.
And that work has given us a strong and diverse portfolio. And so that's what you get when you buy into forward partners. So exposure-wise, 40% of the portfolio and growing is in applied AI, with marketplaces and e-commerce coming in behind. And then the second thing I point to here is that the top 15 is just under 3/4 of NAV, and that's 44 pence per share. And that, as Luke was saying, that top 15 is growing extremely fast, 144% last year, and their cash positions are healthy. And that 44 pence per share in that attractive group of companies, that compares to the share price of 36.5 pence this morning.
So you'll have seen some of these numbers already discussed about the portfolio value and the share price. The one I draw your attention to is the capital deployed of 9.7 million. That was made up of 2.4 million for new investments and the follow-ons being 7.3, which has really supported that stronger balance sheet moving forward. And the cash realizations of 1.1 million. And then what we've looked to do, and as we advise our companies, we ask them to maintain a healthy cash position and their OPEX moving forward. So we do the same with ourselves, right? So what we've done for the business is right-size our OPEX for moving forward, and we've just refocused the team there into that end. What I would say is we disclosed the interims that advances was to wind down. That is to support the OPEX going forward. And that should reduce the OPEX from around 7.7 million in 2022 to near the 2021 number of 4.8 million. And this graph here, this just shows that if you look at our valuations historically, they've trended upwards. There was a slight dip during the pandemic. And again, this dip this year in 2022, predominantly due to those valuation headwinds. But the underlying message here is that the trend is upwards, and whilst there is a bit of a dip now, we expect that to return to growth, hopefully in 2023. And this portfolio value table is trying to bridge here from 2021 year end to the interims and to the 2022 number of 80 million. What I would draw your attention to again is the fact that the valuation decline has slowed. It was 28 million in the interim period, and then it's reduced substantially for the year end.
And we maintained activity throughout the year. And again, as I've said before, the focus was really on strengthening the portfolio. So you see a lot of follow-on investments in the existing portfolio, but alongside that, a number of new investments, which we'll talk about later.
The two things to take away from this slide. Firstly, as already noted, the top 15 is just shy of 3/4 of the value of the portfolio. And we like it that way. That's about the right level of concentration. It gives us a small enough group of value drivers that we can really get our hands around them, make sure we're really driving success, but at the same time, we're not over-dependent on any one company. And similarly, Gravity Sketch, our biggest holding, is actually just shy of 10% of the portfolio on a valuation basis. And again, that's about where we like to have the largest holding. We'll skip over this slide, but for your reference, if you'd like to see where the portfolio companies sit with respect to our focus areas.
I've said a few times, we made 3 investments last year, and we're really excited about these companies. All 3 have built good momentum and really happy to talk about them. So Baseline, we invested alongside Sequoia's ARC Accelerator, which targets outlier founders. It's a developer tool helping developers to spot errors and fix them faster and quicker. And what's exciting about Baseline is that they've already incorporated ChatGPT into the product, which means that they can now explain any type of event and suggest AI understanding of what's happening, which speeds up debugging complex errors. With Sunrise, they combine and analyze multiple types of healthcare data for drug development and precision medicine. Precision medicine is a massive area, and we're really just starting to scratch the surface of that. So Pioneers, the Sunrise, a pioneer there. And what's exciting is they've already developed a number of clinical grade AI algorithms. So there's real potential in that platform. And Dines provides an all-in-one solution for hospitality providers, building great momentum. So they grew 3x last year, and they've already signed deals this year that should drive another 3x growth year. So, really strong momentum.
And the 2022 cohort is off to a really good start, actually. And in fact, slightly paradoxically, it's often the case that the investments you make in difficult times turn out to be some of the best. So on this slide, we have a handful of the profiles of some of the more exciting portfolio companies that we've held for a little while. And so First thing I want to call out is that across our three operating models, we get broad industry exposure. So what you can see here is virtual reality software, legal tech software, cybersecurity software, fashion e-commerce, the interesting profitable kind, payment software, and agri-tech via a livestock marketplace. And then to dwell briefly on the two biggest companies in the portfolio by now, two of our biggest NAV drivers, that's Gravity Sketch and Robin. So Gravity Sketch makes virtual reality design software. So you can think of them as Adobe for virtual reality. So they're a global leader in that space, and it's a space which is strategically important to lots of key players, not least Meta. So they're a global leader in that space. They raised a big round last year from top VCs, Accel and Google Ventures, and grew at well over 100%. And then secondly, Robin, they're an AI-powered legal tech business. So they grew at over 200% last year, and they just completed an acquisition which they hope will double revenues again on its own. And perhaps most excitingly, they're really well positioned to ride the generative AI wave. So they have a really strong case to be regarded as the leading generative AI in the legal tech space on a global basis. And as such, they are and as such, they are attracting a lot of interest from VCs, raising the possibility that their next round might come sooner than previously expected, and indeed be at a higher valuation. And as you can see here, the last round was really only a short couple of months ago. So to give you an idea of scale, recent investors in both those businesses, they're hoping for $1 billion plus outcomes. So there's some really exciting potential upside here. So bringing it all together, what you get if you buy into Forward is three things. So firstly, you get a great portfolio. As we said, top 15, 44 pence per share, grew at 144 pence last year. Two, you get a great market. So that the tailwinds for tech startups are just incredibly strong. And in early stages, the best way to play that. And then third, it's managed by a great company. So Forward Partners is one of the strongest brands in early stage venture in the UK, which has got a really compelling offering for founders. So we're waiting for just one thing now, and that's for VC confidence to return to the market. And when that confidence comes, and there's a lot of vested interest in it coming back, but when that confidence comes, that will unlock the up-rounds in our portfolio, which will lead to NAV growth again. And then when we return to NAV growth, we expect that to be the catalyst for a narrowing in our discount. So then the combination of rising NAV and narrowing discount, that should make things very exciting for our shares. So when will VC confidence return? Well, we started seeing recently, seeing the first signs of VC confidence returning post the Silicon Valley Bank collapse. And generative AI is definitely giving our market a boost, but it's obviously impossible to say exactly when it will turn. But what I will say is that barring some kind of unforeseen new macro problem or some other disaster, so barring that, there is no doubt in my mind, in any of our minds, I don't think that VCs will start opening their checkbooks again before too long. And indeed, there's an increasing chance that that switch could flip imminently. There's just too much opportunity and too much financial capital, human capital waiting on the sidelines for it to be any other way. All right, thank you. We'll take a brief pause and then head over to questions.
Nick, Lloyd, Luke, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we've received a number of questions throughout today's presentation, and if I could just ask you to read out those questions and give responses where it's appropriate to do so, I'll pick up from you at the end.
So which one do we answer first, I suppose, right?
Yeah. Okay. Should I just start?
Yeah.
Okay. We've had a question here about buybacks. So let me read out the question. Given the valuation headwinds and share price discount, why don't you buy your shares back? So as you'd expect, like any good company, we have considered a share buyback, and we've decided not to for two reasons. Firstly, the research we've seen suggests that share buybacks don't make any material difference to the share price over the long term. And secondly, I think there are better opportunities than buying our own shares to make new investments going forward and generate returns for shareholders that way. Okay, moving down. I'll read this out. Maybe you take this one, Luke. So, where are you seeing the most opportunities in AI? And if so, what types of companies are you seeing?
Yeah, so definitely I would say applied AI is the focus area that we're focusing the most on. We're definitely seeing more opportunities there. We've been investing for 6 years, but the trend towards generative AI is very exciting and really has massive disruptive potential. I think the bit we're most excited around is founders who have real understanding of an industry and its pain points and leveraging these new technologies to solve problems in a way that wasn't possible before, and particularly where they can combine that with the potential to pull in data or build proprietary data sets that mean that they have an edge in terms of fine-tuning models and delivering better results. So I think that's the kind of thing we're seeing at the minute. That's really exciting us.
Thank you, Luke. There's a question about the studio here. Please, can you tell us a little more about the studio and how you help the CEOs of your investee companies? Why is it so important, stroke helpful for your investees? So the studio is important, and indeed helping our investee companies in general is very important because, as I said, in our view, and I think all the best VCs think of it, so venture capital is a services business. It's a slightly strange one because we choose to turn down 99.9% of the potential customers we might provide services to, but the best founders have a choice, and they choose the VC fund that gives them the best the best balance of good valuation and a good service. And you don't want to win on valuation alone, so therefore it's really important to have a good service. It's really important to have them want to work with you because they think they will get the best chance of success, or better chance of success if they take money from you than another investor. And so the principal focus with the studio team now, as I was saying, is helping our companies get great people into their businesses. And that's really important, particularly at the early stage, where it's a real challenge for founders at the early stages because agencies just don't work well with small companies. They can't make enough money, and so the high-quality agencies choose to work with bigger companies, and so there's a real market inefficiency at the bottom end of the market that we can step into, and we're able to step into it very effectively because as a VC, we have a good brand. So when we call our potential candidates, they take our call. Whereas companies call them directly, or if no name or unknown small agency reaches out to them, they don't take that call. So we're able to provide a lot of great support to our portfolio companies through the studio in that manner. It's also worth calling out, and maybe I hand it over to you, Luke, how we support from the board.
Yeah, so working with portfolio founders via the board is a really important part of what we do. So that's acting as a sparring partner, helping them think through big strategic challenges. So last year, a lot of that was understanding the implications of the tough times from a fundraising perspective. We're constantly our peers and other funds, so we can quickly build a view that is very difficult for the founders to build themselves from the small part of the industry they're seeing. So we're able to help them understand what's happening in the market and push them to take the kind of actions that's needed to put the business in as strong a position as possible. Generative AI is another space where we're putting a lot of work in to understand this trend, and so we can sit with our portfolio founders and help them think through the implications for their business and what they need to be doing to take advantage of the opportunities and minimize the risks.
So there's a question here. Why are you trading at such a discount to NAV, and what are you doing to close the discount? So the reason that we're trading at a discount to NAV, if you pare it all right back, is obviously that public market investors are not valuing our portfolio the same way as we do, same way as recently passed through our end of year audit. And so why would that be? And this is kind of what we hear on the grapevine, is that there's an implicit assumption amongst public market investors that there are further write-downs still to come from our portfolio. And it's not just us, it's a kind of blanket assumption across the listed venture capital sector. If you look at other listed VC businesses that are similar to Forward, then we're all trading at kind of roughly similar discounts. And so there's that assumption that future write-downs are coming, and therefore it's baked into the price already. And what we've been trying to get across today is that we think that we don't share the view that assumption is a good one to hold. There's a lot of growth in the portfolio. We took, the valuation went down by a lot last year, and there's reasons to believe that investors will be returning to the market soon, and we'll start to see the up rounds, which will start driving our NAV back up again. So that's why we trade at a discount. What are we doing about it? Well, firstly, we're out explaining to you and to everybody else relevant that we can speak to why we think the discount is overdone, setting out the story. And then two, we are working hard to make contact with investors who can make investments in our shares to move the share price. Those are the two main levers that we have to pull.
And I think I'd add to that, Nick, when it comes to valuations, we do follow the IPEV guidelines, the International Private Equity Valuation Guidelines. That's market standard for all VC and private equity firms, particularly the listed ones. And we do have a robust audit process. GT do contribute to the IPEV guidelines as well. And we do work with Kroll, who are our advisors. They're formerly Duff & Phelps, and they are considered to be the leader in valuations for VC and private equity companies. They also sit on the board of IPEV. So what we would say is we do go through a robust process to get the fair value for the portfolio. And that is thoroughly tested with GT. I can tell you that for sure. So whilst maybe the market does have a different view on the tech sector, I feel confident that the work that we've done to come to arrive at the portfolio valuation is robust.
Thank you, Lloyd. And maybe one more question. I think we'll bring it to a close. I think this is one for you, Luke, but I'll read it out. Have you turned down any follow-on opportunities in the companies you are currently invested in, and how do you balance the attractiveness of new investments versus supporting existing? Is there a preference?
So yes, we have turned down follow-on opportunities in cases, and I think for a follow-on to make sense for us, a few things have to apply. So one, we have to believe in the business and the potential of the business to drive strong returns for Forward. The quantum of investment has to make sense for Forward, and it has to unlock other capital from other investors. And so where those things apply, we will make follow-ons and support the existing portfolio. And yes, we balance the potential for returns from the existing portfolio where we know the companies, we understand them, we have a good sense of the strength of the founders and the prospects for the company, with exciting new opportunities. And so there, we're balancing against what we think are the potential outcomes and the size of investments required. So we're constantly doing that. Actually, I think we expect less follow-on this year than last year because of all the work we put in last year to put the balance sheets in a strong position with the portfolio.
Yeah,
Nick, Lloyd, Luke, thank you very much indeed. Perhaps before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Nick, could I just ask you for a few closing comments?
Yes, thank you everyone for listening in, and please do share your feedback with us. To finish, 2022 was a difficult year for us, but as I hope you've heard, the future is much rosier. And also, if you'd like to meet with us more fully or learn more, don't hesitate to get in touch. And I hope you have a great day. Thank you.
Nick, Lloyd, Luke, thanks once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Forward Partners Group PLC, we'd like to thank you for attending today's presentation, and good morning to you all.